Would you say that peer-to-peer lending is generally less risky than, say, investing on the stock market?
Well, that's a hard one to answer, and once again, because that's quite a general question. So if you said investing peer-to-peer into property developments versus investing into Spark on the share market, then I'd say the Spark investment's probably more conservative than lending to a property developer.
Oh, okay. All right. Interesting. Yeah.
So you obviously get volatility in your capital. So if you invested, let's say you've invested $10,000. If you invest that in Spark and the share price goes up and down, then the value of your $10,000 is kind of going up and down with that. But you're also getting dividends along the way. If you invest into a loan, then assuming that that loan is paid back, you're going to get your principal back. So you're going to get your $10,000 back. And along the way, chances are you've earned some sort of return. And it could be monthly, it could be at the end of the loan. It depends on the terms that are offered. Right.
Okay, cool. So what sort of investment demographic do you usually see investing in peer-to-peer lending platforms?
So you see a really wide range. So age-wise, I think about Squirrel. So if I use that as an example. So with Squirrel, we have 18-year-olds investing, and we also have 90-year-olds investing. And there's people right through that age range. We see people from all parts of New Zealand investing. So it's not like it's just, metropolitan areas. We see people from provincial and very small set of locations investing. Probably the biggest difference is more a behavioural trait that I see from investing. And for peer-to-peer, I think there's something about being quite an active investor. So you're paying quite a lot of attention to what's going on day to day with your investments, as opposed to someone who just wants to put their money in a term deposit for 2 years and they know 2 years' time the capital
money will be there.
Yeah, that's right. So peer-to-peer tends to attract people who are more active in their investment style.
Cool. So from a technical point of view, let's say if I invest money with Squirrel and I put money into, say, a business development loan, right? One of those business property loans that you were talking about, right? So what happens with the money that I, as a retail investor, invest into Squirrel?
We'll use Squirrel as an example, and different peer-to-peer providers will have different options available. So I'm just going to talk about Squirrel here. So with Squirrel, we know lots about New Zealand homeowners, and they are our target market as an organisation. So we help them with buying homes, a lot of which are financed by banks, and a small portion of them Squirrel offers to our peer-to-peer investors for those investors to invest in. If you think about the New Zealand mortgage market, there's, I don't know, in round numbers, $320 billion worth of home loans in the New Zealand market, okay?
That's huge.
It's an absolutely enormous market. If you compare it to, the total capitalization of all the companies on the NZX, it's about 180 billion. Okay? So home loans dwarfs the size of the NZX. If you think about government debt, core government debt is about $80 billion in New Zealand. And if you take just not the core piece, but all of the government debt, it adds up to about $140 billion. Home loans is 320. So just to give you the scale, home loans mind-blowingly large. I think of all the money invested in KiwiSaver is about 85 billion today. So home loans is the single biggest financial market in New Zealand. But people tend not to think about it like that. So the banks have done a great job of, from an investor's perspective, of actually locking up that pool of money. With Squirrel, we concentrate on homeowners. So we have obviously our mortgage broking team, and we have our lending and investment options. So we present 3 different styles of investment to our investors. So I'll describe each of them briefly. The first one is home loans. So these home loans are for borrowers in a couple of niche segments. So they could be older borrowers typically, and banks tend to be quite gun shy of lending to older borrowers. And when I say older, I don't mean that old. I mean people aged over 55, which is not that old in the scheme of things. We're not talking about 80-year-olds. Yeah.
Especially when the life expectancy is like 80, 90.
And so banks tend to start wanting to see people pay down their debt more quickly. Once they get 155, and they don't tend to offer as much flexibility. So from a Squirrel perspective, we see them as really good credit risks. These people have often had debt for a long part of their lives. They understand what it means to have debt. They tend to have lots of equity. So, the value of their loan versus the value of their assets, value of loan is low, value of assets tends to be higher. So they're pretty good credit risks in the scheme of things. And banks, for a range of reasons, tend to provide a lot less flexibility and will give them more flexibility. So with our home loans, they're on existing property, existing dwellings, could be rental property, or it could be owner occupied. The maximum loan to value ratio that we support is 80%. So that means if it's, let's say, $1 million property, then the maximum loan you can get on that from us is 800,000. So that means there's 200,000 of owner's equity in that property. And on average, it's closer to 70% LVR. So that means there's 300,000 worth of equity. Property.
Right. Sorry, just to interrupt you on that loan to value ratio. Like, do you have caps on the income of your borrowers? Like, I think BNZ recently announced that they are doing a 1-to-6 ratio, I believe. Yeah. Will you be looking and doing that as well?
So that's known as a debt to income ratio.
Yeah, debt to income ratio. Yeah.
Yeah. So with Squirrel, we're not looking at doing that today. That doesn't mean we won't do it at some point in the future. The key thing with a lot of with the vast majority of loans that Squirrel provides to its peer-to-peer investors is there's a clear exit plan. So often that loan is only going to last somewhere between 1 and 3 years, and sometimes even shorter than that, because another one of those niches that we lend into is bridging loans. So that to explain a bridging loan, that's where a homeowner has bought another house, but they haven't sold their existing house. They've still got to pay for the new house. So they need some money to bridge that gap until they sell the old house. And those loans can last anywhere from, 3 weeks to 6 months, but often quite short term in nature. So for that type of lending, so investments into home loans, Squirrel has a 4% return for investors, and that's on a variable rate. So unlike a term deposit where the rate is locked in for the 12 months that you've taken the term over, if interest rates start rising in the market, then the return for investors would rise, and the rate that the borrower pays also rises.
Interesting. Yeah.
We're heading into a rising rate environment.
That's for sure. That's sure. Yeah. Gotta bash down inflation somehow, right?
That's right. That's right. And so with Squirrel, those investments are variable rate. So that means assuming interest rates are going to rise over the next wee while, which is what all the economic forecasters are saying, then you'd expect that return will also rise those interest rates.
Oh, cool.
So that's the first investment. The second option that we have available, or second investment class for construction loans, we call them business property loans because they're loans for business purposes. Key thing though is they're still over residential property, and we still have a first mortgage in place. Just like home loans, we have a first mortgage in place as security. So these loans, often we're lending to a builder or a franchisee of a building company. So like a Generation Homes would be an example. And we're lending to them for the purposes of buying a piece of land, building a house or maybe a couple of townhouses, and then they're going to sell those houses once Code of Compliance is issued. Most of the time, the houses are pre-sold. So a house buyer has paid a deposit to the builder. And once the house is finished, they'll effectively buy the property. So for those loans, once again, maximum LVR is 80%, but typically it's lower than that. It's 60%. For our investors, they're earning 5% per annum on those loans. Once again, variable rate. So in a rising interest rate environment, you'd expect those returns to go up. Over time. And first mortgage security in place, maximum loan size is 2 million, and the typical loan size is a lot less than that. It's probably about 1 million. And that prevents us from getting into that property development space or large scale property development, which I think if you remember back to what I said earlier, the credit risk on property development is actually
really quite high.
And so the distinction with our business property loans is that it's a single house on a single section, typically, or maybe it's a couple of townhouses. So it's really easy to determine the value of that, and you're not reliant on selling 40 sections or 40 different houses in order for that loan to be paid back. So the third investment class that Squirrel offers are personal loans. So with our personal loans, we only lend to New Zealand homeowners, and the three areas that we typically lend into. So one would be renovations for an owner-occupied house. Second one would be tiny homes. So we're one of only one or two of a handful of lenders who lend on tiny homes in New Zealand. Yeah. So typically tiny homes, they're less than 40 square meters. They're often transportable. So they're not fixed to the ground. So they could be on wheels, like on a trailer, or they could be on skids, which needs a hired truck to go and pick them up. And yeah, we've found that market to perform really well on the lending front. We've been lending into it for about 3 years. So yeah, we consider, the vast majority of those tiny homes are being bought from an owner-occupied perspective. And yeah, so we consider them homeowners. And then the third category is first home buyers. So often first home buyers, there's a niche in that market where they have high income or, pretty strong income.
Yeah.
They have started saving, but haven't managed to save much yet. And the way house prices have been going, it's been better off if they can buy earlier.
Oh yeah, tell me about it.
Dan, as a first home buyer yourself, you know exactly that story.
Yes, I know the pain, I know the struggle. Yeah. So
there's a niche in that first home buyer market where Squirrel has created a product specifically for them called Launchpad. And so we have investors investing under personal loan terms who effectively help provide that deposit for those first home buyers, which allows them to buy sooner than saving over time.
Oh, that's really amazing. I think that it will really help people who actually already have that large income or who have just started making that big income really jump on the property ladder.
For sure. So investor returns for our personal loans for homeowners is between 6 and 7.5%. And there's some different terms. So a 1 year term has a 6% return, for example, and a 5 or 7 year term has a 7.5% return for the investor. Those rates are fixed rates. So when you take those on, you're locked in for that, that period, as opposed to the variable rates that I described before.
Yeah. Thanks for talking about the different investment products that Squirrel has. Thanks for tuning into our podcast, team. Join us next time for our final session with Dave, and we'll learn more about keeping your P2P investments safe and how Squirrel is making home loans accessible to all. Stay positive!